This topic focuses on comparing opposite accounting concepts. For instance, accounts payable versus accounts receivable, and depreciation versus amortization, and each pair represent opposites or contrasting ideas, which are clearly explained in this video. And the first concept, accounts payable versus accounts receivable. Accounts payable means money the business must pay to others. It's a liability of a business. And accounts receivable is money the business will receive from others. It is treated as an asset. Accounts receivable is an current assets and accounts payable is an liability. Next point, depreciation versus amortization. And depreciation and amortization is opposites words. Depreciation opposites amortization. And depreciation means it's an expenses and it is an expenses required at the time of fixed assets. Wear and tear and uses of fixed assets is known as depreciation. The depreciation only charged for tangible assets such as land and building, plant and machinery, etc. Amortization is charged for intangible assets, patent, goodwill, copyright, etc. Next point, revenue versus net income. Revenue means total money earned by sales. We get money from sales is known as revenue. Net income means profit after all expenses are removed. All expenses are removed, we get profit is treated as net income. Next point, accrual accounting versus cash-based accounting. In accrual-based accounting, record when earned or when expense occurred. Record when earned or when expense occurred. In cash-based accounting, record only when money is received or paid. Cash-based accounting, record only when money is received or paid. Next concept, book value versus market value. Book value written in company's books and market value price. Market value means price people are ready to pay in the market. Book value is equal to as per company's records and market value is current selling price in the market. Next point, journal versus ledger. Journal first place to record transaction on the basis of date. It's known as chronological order. Next point, ledger. Arrange transaction by accounts. Arrange transaction by accounts. For example, cash account, sales account, purchases account, etc. Next, fixed cost versus variable cost. Fixed cost means stays same even if production changes. Stays same. For example, rent. Rent has no changes. Even if the production changes or we earn profit or anything like that. Variable cost. Change with the production. Raw materials cost is also change. The changes in production. The variable cost depends upon the production process. The variable cost is changes with the production. Next, capital versus revenue expenditure. Capital is long-term asset purchase. Long-term asset purchase is known as capital. Revenue is day-to-day expenses. Gross profit versus net profit. Gross profit, revenue minus cost of goods sold. When we make a trading account, we get gross profit, and net profit means profit after all expenses. When we make profit and loss account, we get net profit. Balance sheet versus profit and loss. Balance sheet shows assets and liabilities at date on a particular period. And profit and loss shows income and expenses for a period. Profit and loss account shows income and expense for a period. Direct cost versus indirect cost. Direct cost, direct link to product. Indirect cost, general expenses, rent, electricity, etc. is come under the indirect cost. Direct cost, directly linked to product. Capital receipts versus revenue receipts. Capital receipts is one-time or rare inflow, loan, share capital, etc. It's known as capital receipts. Revenue receipts means regular income, sales, interest, etc. is come under the revenue receipts. Assets versus liability. When the business was, assets means the business wants. Liability is what the business was. Next point, trail balance versus balance sheet. Trail balance to check mathematical accuracy. When we prepare trail balance to check the arithmetical accuracy of accounts, ledger. Balance sheet shows the financial position. That is a difference. It's a difference between trail balance and balance sheet. Owner's equity versus retained earnings. Owner's equity means total investment of owners. Retained earnings means profit kept in business. Retained earnings means profit kept in business. Next point, gross income versus taxable income. Gross income means total income before deduction. Taxable income means income after deduction. Income after deduction. Profit versus cash flow. Profit as per the accounting rules. Cash flow, actual money coming in and going out. Cash flow. Cash inflow and outflow is an example. Earning as per the accounting. Cash flow, actual movement of cash flow, inflow and outflow. Operating versus non-operating income. Operating income means main business is income is known as operating income. Non-operating income means extra income, interest, rent received, etc. are the additional income earned by the business is known as non-operating income, and operating income is the main business income. For example, sales. When we get income from sales. Provision versus reserve. For a non-expense or liability is known as provision. For a non-expenses or liability. Reserve means for future uncertainty. We preserve some cash for future contingency is known as reserve. Tangible assets versus intangible assets. Tangible assets are physical asset, can touch and seen is known as tangible assets, and tangible assets, non-physical assets, it cannot be touched and seen. So, it is known as intangible assets. Brand name, patent, copyright, goodwill is come under this category. Next, debit note versus credit notes. Debit note means buyer sent to seller to reduce amount payable. Buyer sent to seller to reduce amount payable. Credit notes, seller sent to buyer to reduce amount receivable. Inventory versus stock. Inventory means all materials held for production is known as inventory. Raw materials is come under the inventory. Goods is also known as an inventory. Stock, goods kept for sale is known as stock. Inventory means all materials held for production. Next means expense versus expenditure. Expense means operating cost and expenditure means any spending, both capital and revenue. Expense versus expenditure. Expense means cost assumed in operation. And expenditure, any spending of fund is known as expenditure. Next point, financial accounting versus management accounting. For external people, investors, government, etc. We are preparing financial accounting for external people. For external reporting, we use financial accounting, management accounting for internal decision making. For internal management decision, we use management accounting. Trail balance versus journal. Trail balance. List of ledger balance is in the trail balance account. No, trail balance is not an account, it's a statement. Journal. Original record of transaction is known as journal. We record the transactions in journal. Original record of transaction. Cost accounting versus financial accounting. Cost control and production included in cost accounting. In financial accounting, overall financial performance are included. Next, capital employed versus working capital. Capital employed, long-term funds used is known as capital employed. Working capital, current assets minus current liability.